The average American credit card holder pays $1,155 in interest every single year. But here's what's truly disturbing. That 19.9% APR you're seeing? It's not designed to make you money. It's mathematically engineered to keep you paying. Forever. I'm going to show you exactly how credit card companies have created a perpetual debt machine that generates over $120 billion in interest and fees annually. And by the end of this video, you'll understand why even people who think they're being responsible are caught in a trap they don't even see. But first, you need to know something that changed in 1978 that made all of this possible. A Supreme Court decision that year completely transformed American finance. And what happened next? Credit card debt went from $50 billion to over $1 trillion. That's a 2,000% increase. This isn't an accident. This is a system working exactly as designed. Now, before we go further, quick note, this is educational content, not financial advice. Always consult professionals for your specific situation. But what I'm about to reveal? This is information the credit industry spent decades perfecting while keeping consumers completely in the dark. The problem setup. Let's start with something you probably believe is true. You think that if you pay your credit card bill on time every month, you're beating the system. You're one of the smart ones, right? You're getting those rewards points, that cash back, maybe even some travel perks. You're winning. Avatar 1. Except you're not. Even if you never pay a cent in interest, you're still paying. Every single time you swipe that card, merchants pay a fee, usually 2 to 3% of every purchase. And where do you think that cost goes? Built into prices. Every price you see in every store is already inflated by an average of 2.2% to cover credit card processing fees. So even if you're that person who pays off their balance every month, you're paying higher prices on everything you buy. But here's where it gets really interesting. Look at this growth curve. This isn't gradual. This is exponential. And it starts at one very specific moment in history. That spike you just saw begins in 1978 with a case called Marquette Bank versus First of Omaha Service Corp. The Supreme Court ruled that nationally chartered banks could export their home state's interest rate laws to other states. Translation: a bank in South Dakota, where there's no usury cap, can now charge customers in New York, where there traditionally were strict limits, whatever interest rate they want. Almost immediately, banks relocated their credit card operations to states with the most permissive laws. This created a race to the bottom. Delaware, South Dakota, Nevada, these states eliminated interest rate caps entirely, and suddenly, credit card companies could charge 20, 25, even 29% interest, legally. But the system gets much more sophisticated than just high interest rates. See, credit card companies discovered something fascinating about human psychology. They learned that if they made the minimum payment small enough, people would pay it. They'd feel responsible. They'd feel like they're handling their obligations. Here's a scenario that plays out millions of times every month. Someone has a $5,000 balance on their credit card, 19% APR, which sounds almost reasonable compared to some cards out there. Their minimum payment? Just $100 a month. So they pay it. Every month. On time. They're being responsible, right? Their credit score even goes up. But if they only pay that minimum, it will take them over 30 years to pay off that $5,000. And they'll have paid over $9,800 in interest alone. Think about that. They'll pay nearly $15,000 total for that original $5,000 purchase. And here's what makes this truly insidious. The credit card company structured that minimum payment perfectly. It's low enough that it feels manageable. It doesn't hurt too much. But it's also calculated to maximize the amount of time you stay in debt. Now you might be thinking, well, people should just pay more than the minimum. And you're right. But here's what the experts and the insider documents won't tell you. Section 2. The Mechanism Explained. 6 o'clock. Avatar 2. The Technical Expert. Different ethnicity, female, 35, casual professional attire, analytical tone, modern office background. The minimum payment formula isn't random. It's precisely engineered. Most credit card companies use a calculation that's typically 1 to 3% of your balance, or $25 to $35, whichever is greater. 620. Avatar 2. But here's the mechanism you need to understand. Let's break this down step by step. First, your interest is calculated daily, not monthly. Daily. They take your APR, divide it by 365, and apply it to your balance every single day. 640. Avatar 2.
So imagine you have a $10,000 balance at 20% APR. That's about $5.48 in interest charged every single day. Now, let's say your minimum payment is 2%, which would be $200. Sounds like you're making progress, right? Here's the problem. Of that $200 payment, approximately $166 goes just to interest for that month. Only $34 actually reduces your principal balance. You paid $200, and your debt only went down by $34. Second, there's something called the average daily balance method. This is how most cards calculate your interest. They add up your balance for each day of the billing cycle and divide by the number of days. This means even if you make a payment mid-cycle, you're still paying interest on the higher balance for every day before that payment. Watch how the math works against you every single month. Third, and this is crucial, there's what's called negative amortization risk built into these minimum payments. Imagine you're trying to pay off that debt, but life happens. You charge $50 for gas, $100 for groceries, another $75 for utilities. You just added $225 to your balance. But remember, you only paid down $34 in principal with your last payment. Your balance just went up by $191, even though you made your minimum payment on time. You're moving backwards. Now let's talk about the specific laws and loopholes that make this possible. The Credit Card Act of 2009 was supposed to protect consumers. It required that minimum payments must cover interest plus fees plus 1% of principal. Sounds good, right? But here's the loophole. That law only applies to how the minimum is calculated. It doesn't cap interest rates. It doesn't prevent the daily compounding. It doesn't stop promotional rate tricks. It's like putting a speed limit on one street while leaving the highway unlimited. Fourth mechanism, the grace period illusion. Most cards advertise a grace period of 21 to 25 days. That sounds fair. But here's what they don't explain clearly. That grace period only applies if you pay your entire balance in full every month. The moment you carry any balance, even just $1 from the previous month, you lose that grace period on all new purchases. Immediately. Your new charges start accruing interest from the day you make them. Fifth, let's discuss variable APR. Most credit cards have variable rates tied to the prime rate. When the Federal Reserve raises rates, your credit card rate goes up automatically, usually within 1 or 2 billing cycles. But when rates go down, those decreases take much longer to show up, if they show up at all. 1020. Avatar 2. Between 2022 and 2023, the Fed raised rates 11 times. Credit card rates jumped from an average of 16% to over 20%. That's the fastest increase in 40 years. Millions of Americans saw their interest charges jump by 25 to 40% overnight.
This clause in your cardholder agreement gives them complete
control. Now here's where it gets even more disturbing. Business formal, serious demeanor, dark background. According to Federal Reserve data from 2023, American consumers paid $130 billion in credit card interest alone. Not fees, just interest. That's more than the entire GDP of Ukraine. But let's look at specific evidence of how this system operates. The Consumer Financial Protection Bureau released a report analyzing credit card profitability. What they found was striking. The most profitable customers aren't the ones who default. They're the revolvers. Revolvers are customers who carry a balance month to month, but always make minimum payments. They never miss a payment. They never default. They just keep paying. Forever. Industry documents show that revolvers generate 75% of credit card company revenue. Let me give you a concrete case study. A major credit card issuer analyzed their customer base in 2019. They had 3 million active accounts. Of those, approximately 40% paid in full every month. These customers generated nearly zero interest revenue. 30% were revolvers. These customers generated $2.1 billion annually. The remaining 30% had payment problems, defaults, or bankruptcies.
These customers actually cost the company money in charge-offs and collection expenses. So, mathematically, the entire business model depends on creating and maintaining that middle group, the revolvers. The documents show exactly how they cultivate revolvers. First, they use behavioral targeting. They identify consumers with good credit scores but moderate incomes, people who are responsible enough to pay but don't have enough cash flow to pay in full. These are often young professionals, families with children, or people recovering from medical emergencies. The algorithm specifically targets them for credit limit increases and promotional offers. Second, they use what's called payment allocation manipulation. Here's how it works. Imagine you have two balances on the same card, one at 0% promotional rate, one at 24% regular rate. You make a payment. Where does it go? Legally, they can apply it to the lowest rate first, so your payment goes entirely to the 0% balance, while the 24% balance keeps growing with daily interest. This was standard practice until the Card Act required payments above the minimum to go to the highest rate first. But that only applies to amounts above the minimum. Third, timeline evidence shows systematic targeting during economic stress. In 2020, during the pandemic, credit limit increases actually accelerated. While people were losing jobs and income, credit card companies increased limits by an average of $1,470 per cardholder. Why? Because they knew people would need that credit to survive. And they knew that once someone starts relying on credit for essentials like groceries and rent, they become long-term revolvers. The data proved them right. Revolving balances increased 37% between 2020 and 2023. Fourth, let's look at the fee structure evolution. In 1990, the average late payment fee was $13. Today, it's $41. Overlimit fees went from $13 to $39. Return payment fees, also $39. These fees are calibrated to be just below the threshold where people would dispute them or close their accounts. Geographic data reveals which states carry the most debt. Interestingly, it correlates almost perfectly with states that have the highest cost of living but not the highest incomes. The gap between expenses and income gets filled with credit cards. But the most shocking part? The entire onboarding process is designed to make people fail. I'll explain in just a moment. The implications. Avatar 4, the analyst. Bright, here's what this means for you personally. If you're carrying a balance right now, I want you to pull out your last credit card statement. Look at the minimum payment. Now look at how much of that actually goes to principal versus interest. For most people with average balances, less than 20% of their minimum payment touches the actual debt. The other 80+% is pure interest going straight to the credit card company. That's your money, money you worked for, and it's evaporating. Your financial future is being transferred at a rate of 15 to 25% per year from your pocket to corporate profit margins. Let me put this in real terms. If you're paying $500 a month in minimum payments across your cards, and 80% is going to interest, you're paying $400 monthly just to stay in place. That's $4,800 per year that could be going to retirement, emergency savings, your kids' education, or paying down your mortgage. Instead, it's servicing debt that keeps regenerating itself. Now let's talk about future implications. As interest rates remain elevated, the Federal Reserve projects prime rate to stay between 7.5 and 9% through 2026. That means credit card rates will likely stay in the 20 to 25% range. For context, that's higher than the return most people get on their retirement investments. You literally cannot invest your way out of high-interest credit card debt. The math doesn't work. You're losing money faster than you can possibly grow it. Here's a scenario millions of Americans face. You have $15,000 in credit card debt, average rate of 22%, minimum payment of $300 monthly. If you stick to minimums, you'll be debt-free in 44 years. You'll pay $51,000 in total, for $15,000 in purchases. But if you can somehow scrape together $600 monthly, double the minimum, you'll be free in just under 7 years and pay about $27,000 total. Still painful, but you saved $24,000 and 37 years.
The systemic problem runs deeper, though. This debt structure is creating generational wealth transfer. Middle-class families are paying hundreds of billions annually in interest to large financial institutions. That's money that could build small businesses, buy homes, fund education.
Instead, it's extracted systematically through a mechanism most people don't even understand they're caught in. And because minimum payments feel manageable, people don't realize they're on a 30-year payment plan for last year's groceries. Your purchasing power is being permanently reduced. Every dollar you owe at 20% interest costs you $1.20 just 1 year later. Over a decade, that same dollar costs you over $6. This is why people feel like they're working harder but getting nowhere. The guide. Return to Avatar 1. Same professional appearance, hopeful, empowering tone. So what can you actually do about this? First, understand that awareness is power. Just knowing how the system works puts you ahead of 90% of credit card users. Here's your action plan. Step 1. Stop using the card that's carrying a balance. Completely. Every new purchase you make is accruing interest from day one because you've lost the grace period. You're essentially taking out a 20% loan for every coffee you buy. Step 2. Pay more than the minimum. Even $25 or $50 extra makes an exponential difference. On that $5,000 balance we discussed earlier, paying just $50 extra monthly cuts your payoff time from 30 years to 12 years and saves you over $6,000 in interest. Step 3. Use the avalanche method. List all your credit cards by interest rate. Pay minimums on everything except the highest rate card. Attack that one with every extra dollar you have. When it's paid off, move to the next highest rate. This mathematically minimizes total interest paid. Yes, the snowball method where you pay smallest balance first feels better psychologically, but Avalanche saves you real money. Step 4. Call your credit card company and ask for a rate reduction. Seriously, if you have good payment history, they'll often reduce your rate by 2 to 5 percentage points just to keep you from transferring to a competitor. That can save hundreds annually. Step 5. Consider a balance transfer strategically. Many cards offer 0% for 12 to 18 months. But here's critical. You must have a plan to pay it off during that promotional period. And watch for transfer fees, usually 3 to 5% of the balance. Step 6. If you're really underwater, look into nonprofit credit counseling. Organizations accredited by the National Foundation for Credit Counseling can sometimes negotiate lower rates and create payment plans. They're not debt settlement companies that trash your credit. They're legitimate counselors. Now, what needs to change systemically? We need federal interest rate caps. Several states have proposed 15% maximum APR on credit cards. That's still profitable for banks, but prevents the most predatory rates. We need transparent minimum payment disclosures. Your statement should be required to show exactly how long it will take to pay off your balance at the minimum payment, and how much you'll pay in total. Some states have started requiring this. We need restrictions on credit limit increases without explicit consumer request. Banks shouldn't be able to just raise your limit and send you a notice buried in your monthly statement. So now you know the truth. Credit cards aren't designed to help you build wealth. They're mathematically engineered to transfer your wealth to corporate profits through minimum payments that feel manageable but create decades of debt. The question is, what are you going to do about it? Are you going to keep paying the minimum and funding your credit card company's quarterly earnings? Or are you going to break free? Let me know in the comments how much you've paid in credit card interest this year. I bet the number will shock you. If you found this valuable, hit that subscribe button because I'm going to keep exposing exactly how financial systems are designed to extract wealth from regular people. And if you want to understand why your savings account pays 0.01% while they charge you 24%, check out my next video. Remember, the game is rigged, but you don't have to play by their rules. Thanks for watching.